Thank you very much. I'm absolutely delighted to be back in Bangkok. I have had the pleasure of being at a previous Bank of Thailand conference a number of years ago in Chiang Mai, which was both a spectacular conference in its substance and also in a spectacular setting. And so, as I said, I would like to thank the governor, or I'd like to thank PT. I would like to thank so many of the people who have made this possible for me to come back and come to this excellent conference. And it's very impressive because the conference that I had attended a number of years ago had a much smaller audience. And it shows the importance of these issues, the importance of what the central bank is doing, and in particular research at the central bank, to see an audience of this size. I'm really delighted and humbled to be here. The generous Thai hospitality is as great as it has ever been, and so I've had a great experience so far, and I look forward to more meetings with many of you and more questions that will be coming as we go forward through the day. Well, it's the 10th anniversary of the financial crisis, and so that's a very good time to come back and reflect on what happened, what have we learned, and most importantly, what should we be doing going forward? And so I want to think about a few different issues related to that. I'm going to put things into three basic ideas of what I want to look at. First are the macro issues and the inflation issues, because of course, when I was at the Federal Reserve from 2006 to 2009, we started to engage in quantitative easing. There was a major concern that we would have very high inflation, and obviously that hasn't come to pass. So try to understand what's gone on the macro monetary policy side, what have we learned, and a little bit of what the exit is likely to mean. So that's the first theme. Second theme is to think about what were the real fragilities that caused the crisis. Have we responded to those? And in particular, I'll be looking at some of the international and U.S. responses in Dodd-Frank and in the Basel capital and liquidity requirements to see what we have and haven't done, and also to think about some of the unintended consequences. Because of course, what we were trying to do is make markets more stable, make institutions more stable. And I think the motivations were all very good. Some of the consequences have been positive. Some of them have not been as positive, and those are the unintended consequences, and I want to talk a little bit about that. Also talk about what's going on in the United States now in some of the reforms of the Dodd-Frank reforms themselves. And then finally, what I want to go to is think about new challenges. Where are we going in the future? Because we want to learn the lessons from the past, but we also want to realize that things have changed. And a lot of the discussion over the last day and a half has been about technology, fintech, and the issues related to that. And I think there's an incredible opportunity here, whether it's for financial inclusion, for greater efficiency and lower cost, but there are also a whole new set of risks that come with that, in particular cyber-type risks. And so I really want to make sure that we think about, when we go forward, not just cyber and technology as a technical issue, but it also potentially can be a broader financial stability issue. And so first, what I want to do is think a little bit about the macro situation as I had mentioned, and really want to think about how we might get out of what some of the concerns were back a few years ago and where we are today. So as you may recall, many of my colleagues at University of Chicago, as well as a lot of others, had written a letter to the Federal Reserve and to Ben Bernanke saying, this quantitative easing is going to lead to high inflation. You know, have you lost your mind? Have you forgotten about the dual mandate that the Fed has for maintaining maximum employment growth, but with low and stable inflation? Well, it's 10 years on, so I think I get to declare victory that we have not had hyperinflation in the US. Now, maybe at some point in the future we will have high inflation, but the last decade we have not. We've had inflation that has primarily been below the Fed's 2% goal, and so I think we have not seen that sort of concern about high inflation manifest in the US, or really in any of the other central banks that have engaged in some form of quantitative easing. Now, why was that? What have we learned from that? Well, there's a basic thing in monetary economics of a very strong distinction between the amount of bank reserves that are in the system and the amount of money in the system. And so in traditional circumstances, when central banks are buying assets and increasing their balance sheet, that creates bank reserves that then create money supply, and that leads to inflation. Well, we haven't seen that. In the US, we had an enormous increase in the Fed's balance sheet from $800 billion to more than $4 trillion, but almost all of that was in terms of higher cash holdings or higher reserves that the banks were holding with the central bank. So it didn't lead to explosive money growth, didn't lead to inflation. Some of that was due to regulation of wanting banks to hold more liquidity, but a lot of it has to do with just the market pressures and the way banks were going to operate. They realized they didn't have those kind of cushions that they needed from before. And so they've been operating differently, operating with much higher cushion of reserves, and so that's why you can have this explosion in the money, explosion in central bank balance sheets, an explosion in bank reserves, but not lead to inflation. And obviously, Japan is an extreme example of that, because now the Bank of Japan's balance sheet is 100% of GDP, continuing to grow, and Japan continues to have low inflation rather than high inflation. So there's no necessary connection between the size of the central bank's balance sheet and the amount of inflation that is there. And that's also created some of the puzzles that we've been looking at in some of the sessions here. Why have we had such low inflation despite economic growth, despite central banks trying to push inflation back to its normal level? But I think that's an important part of the lesson that I think some of my colleagues and many people had forgotten. Well, now let's think about, well, what are the consequences going to be for exit? So the U.S. Federal Reserve has been one of the first of the major central banks to be raising interest rates and to be reducing its balance sheet. There have been a lot of concern that the equity markets were pumped up with just the so-called sugar high that came from all of the central bank stimulation, and that once they started to pull back, both by raising rates and reducing the size of the balance sheet, the markets would collapse. Well, obviously that hasn't been the case. The U.S. stock market has continued to be strong and is at or near record levels. Asset prices in general have continued to be strong. The U.S. economy has been growing more rapidly, not less rapidly. Now, obviously, there are other policy changes that have occurred with both regulatory reform and tax reform that have been helping to boost investment and boost economic growth. But the fear that, once we sort of started to take the punch bowl away, that would lead to a collapse wasn't the case. Now, of course, there were some bumps along the way. We had the taper tantrum from 2012, but we've had the exit from the increase in the size of the balance sheet to actually decreasing it, the discussion of it. I think Janet Yellen handled that extremely masterfully, and as she had said, and other central bank officials in the U.S. had said, it was exciting as watching paint dry. It was to be boring, so it wouldn't cause any tumult in the markets, and so far it really hasn't. So I think that exit has gone reasonably smoothly. Mario Draghi just yesterday was talking about how in Europe, labor markets are starting to become tight, starting to see more inflation. They're close to they're roughly around their inflation target of roughly 2%. And so he reiterated that they are not only going to stop the asset purchases by the end of this year, but they would gradually start to tighten monetary policy in 2019. The Bank of Japan, as I mentioned, is far from that. They are still purchasing assets, targeting interest rates around zero, and so I think the Bank of Japan is far from exit. Also, I just want to mention China briefly. It's very interesting to see what's happening there as China is slowing. As they've tried to slow the growth of leverage, they've now switched gears a bit and are providing more credit back to the system. And so going in the opposite direction of the tightening that the U.S. and Europe is going in, that's creating some problems for maintaining the exchange rate as it is, and I think that's going to be one of the challenges going forward. Maybe we can get to that in some of the question and answer period about some of the challenges for China as they try to deal with slowing the growth of leverage or even delevering a bit, but trying to maintain economic growth. Now, obviously, we've been seeing some turbulence in emerging markets. Fortunately, Thailand has largely been insulated from that, not completely insulated, but largely insulated. I've recently been traveling to Turkey and to Argentina, where, of course, there have been major challenges in their exchange rate markets. Now, I hope you don't conclude from that because I was in Turkey and Argentina, they've had trouble, and so trouble is coming to Thailand. I don't think that's going to be the case. The fundamentals are very different here, a different macro situation, a different surplus situation, a much higher savings rate, and so I think that will help to insulate Thailand, at least to some extent, from turbulence in these markets. But this is one of the issues that is still there, these interconnections, the contagion that can occur. And that's what I want to now switch to from this more sort of macro overview to thinking about some of the sources of fragility that I learned from my time at the Fed. What are the kind of these fundamentals, and what have we done to try to address that? Because as we know, some of these interconnections, some of these contagions can still occur. We certainly have not gotten rid of all of the problems that are in the system, and so making sure to focus on financial stability, making sure to think about macroprudential policies and continue to do that, especially in light of new risks that come up, is extremely important. We certainly can't declare victory. I can declare victory that we did not have high inflation or hyperinflation after a decade, but we can't declare victory that we've gotten rid of all of the fragilities in the system. Far from it. There are always going to be some of these fragilities. Well, what were the key sources of fragility that I think we saw in the global financial crisis, and that we always have to be very, very attentive to when we are thinking about bank and financial regulation? The first is capital. We had very high leverage in the financial system in the U.S. We had true loss-absorbing capital of common tangible equity on the order of 2 to 3% for our major institutions. Far too low. It didn't take much uncertainty in the value of part of their portfolio, in particular the housing part of the portfolio, to lead people to question whether these institutions were solvent or not. And so we've significantly increased capital, in particular tangible common equity and Tier 1 capital, very significantly both in the U.S. and globally through the Basel process. And this is something that is extremely important and an important lesson from the crisis. Second is liquidity. Another very important lesson from the crisis is how quickly liquidity can just disappear. Deep liquid markets just could vanish. Something like commercial paper markets, and in particular asset-backed commercial paper, where the asset was housing. It was a deep liquid market, had grown extraordinarily rapidly through the 2000s. Suddenly, in the summer of 2007, basically 2 to 3 years worth of growth disappeared within 2 months. And so the amount of asset-backed commercial paper collapsed, and so the funding for the mortgage vehicles collapsed, and so a deep liquid market that had been so crucial for the U.S. housing market and so much in the markets and then global markets came down. And so obviously we now have much better focus on liquidity, much better focus on liquidity management. I think there's still a bit of a struggle to get the exact regulations right, but I think we've made a lot of progress on that piece. The third piece are interconnections. And we've seen how interconnected the banking system is throughout the entire economy, but also there's so many institutions that are not traditional banks that have come in. Now, I know here in Thailand, it's still very much a bank-centric structure, but that's going to be changing. As fintech players come in and there's more financial innovation, there'll be more variety of players that will be important to these markets. And even for the banks, there'll be more variety of players who will be important to the financing of the banks. We certainly saw that in the U.S. Through the 1970s, 1980s, and 1990s, and into the 2000s, where banks became a smaller part of the total financial asset mix. That in and of itself is not a problem. It suggests that there was more competition and more alternatives for people. That's all very good. But the regulators weren't keeping up with some of the risks that were coming from these interconnections. There are a number of interconnections that we didn't understand fully and didn't see. And certainly I was there when we were dealing with, for example, American International Group, AIG, which was an insurance company that was providing a lot of insurance through a particular type of derivative product, the so-called credit default swaps, which are basically just an insurance product in case there was a downturn in the housing market, in case there was a downturn in a particular bond or particular company that couldn't repay its bonds. In principle, totally sensible to be providing these kind of hedging instruments into the market. The problem was there was an enormous amount of risk concentration that wasn't understood. Almost everyone was, all of the major institutions were interconnected to AIG. This was an over-the-counter structure, not a centrally cleared structure, so there wasn't that information for the regulators or for many of the market participants to see what the extreme of the risk exposure was. And we also didn't have the IT developments for firms to do that monitoring themselves. So during the financial crisis, I was chairing the Supervision and Regulation Committee. And so obviously one of the questions we had is, what is your exposure to a particular institution? What is your exposure to Lehman Brothers? What is your exposure to AIG? What is your exposure to Goldman Sachs? Now, in the past, those kind of questions had not been asked. The focus of the questions were, have you hedged your exposures? The question was not, who have you hedged your exposures with? But the financial crisis made it very clear that you had to think about that interconnection, that you could very well have hedged all of your risks, but if everyone has hedged one side of the market risk with one particular institution, and that risk comes to bear, that institution is not going to survive, and all those hedges are going to break. And one of the things that was particularly scary during the crisis is when I would ask, and the staff would ask, well, what is your exposure to this particular institution? The answer was, we'll get back to you. Now that's very scary, that these institutions didn't have the IT and technology system set up so that the risk officers and the risk management committee could immediately see what the overall exposure was to AIG, or overall exposure was in a particular aspect of the housing market. And part of that in the US is because the institutions were these sort of Frankenstein monsters that came together through mergers because we had some very silly regulations that did not allow banks to branch. We forced banks to be very narrow in terms of their geographic footprint, and particularly before we had national markets and international markets that developed, you basically forced them to take all the local credit risk. That didn't make any sense. We brought those barriers down in the 70s and 80s. But what we did is we allowed for all the mergers, but we did not put any requirements on that the IT systems had to be fully integrated. I think looking back on it now, I think that's one of the major failures of the regulatory system. We were encouraging the mergers to occur. This all occurred in the 90s through the early 2000s, so before I'd gotten to the Fed. But I think it was something we just didn't think about, that the IT systems were crucial. They're crucial to risk management. They're crucial to operating a large financial institution and global financial institutions. But we had more or less assumed that, well, if the merger occurs and the institution is functioning, that's fine. The regulators don't have to intervene to make sure that the IT system is functioning. But I think that's something that's very important and something that we didn't pay enough attention to. And it really only came out during the financial crisis when we would ask these questions, what is your exposure to AIG? And the answer was, well, we'll get back to you because we have to put all these spreadsheets together from the different divisions. And I think there's a very important lesson in that for for going forward, when we think about the worries that we have, or the potential risks, some of the potential risks going forward, and I'll come back to that in just a few minutes. I want to think about some other aspects of interconnections. One of those is interconnections that we're seeing in China with the growth of wealth management products. Those are very much like the off-balance sheet vehicles that we saw developing in the U.S. The U.S. is primarily about real estate. In China, some of it is real estate, but it's in a lot of other areas, coming up partially as getting around the regulations that had been on deposits. So people were getting very low rates of return on deposits and taking finding potential higher rate of return on these wealth management products. Of course, there's no free lunch, as we always say in Chicago, so you only get higher rates of return if you're taking on more risk, and it may not have been fully understood by the individuals, all the risks that were being taken on. And so China has been dealing with the wealth management products in an important way over the last year or two, trying to rein them in, trying to get better disclosure about them. This is a very important source of finance, especially for small and medium-sized enterprises, as well as some of the larger enterprises. And that's slowed recently. And now China's trying to deal with that because they don't want to slow the growth of these enterprises, but they also are concerned about the wealth management products. And so they're dealing with those kind of interconnections because now there are far more connections between these types of products, between the many different players in the markets, and it's not just the banks doing the loans. The banks also have exposure here, so there are far more layers of intermediation, far more complexities, and so we're seeing something that's a little bit like what we saw during the structures that we had in the U.S. leading up to the financial crisis. Not that I think that the crisis is imminent there in China, but I think it is one of the channels that is going to be problematic for the Chinese to have to deal with, and I think that should be one of the lessons from the crisis, again, of thinking about these interconnections in a very, very important way. We've also seen some unintended consequences of the different types of regulations that we've put in the U.S. and globally. I think in many markets, there's more fragility and less liquidity than there had been from before. Now, of course, that was not what anyone intended. The intent of having higher capital requirements, of having higher liquidity requirements, and imposing things like in the U.S., like Volcker Rule, which made it more difficult for banks to be market makers. The motivation for that was trying to make the banks more stable. Totally sensible, but I think an unintended consequence has been, in some cases, to make some of the markets more fragile, make them less liquid, because banks are unable or unwilling to put the capital into particular markets because they're concerned of running afoul of some of the regulations, particularly the Volcker Rule, and that interacting with higher liquidity and higher capital requirements are making it more difficult for them to act as market makers. They are part of what the new vice chair for regulation at the Federal Reserve is doing, Randy Quarles, is he's trying to think about, well, what are these unintended consequences, and can we reduce those? And so the Fed has proposed doing some reforms of the Volcker Rule. So far, those I think are are not deep reforms of the Volcker Rule, but I think they are trying to go in the right direction of sort of simplifying, improving compliance. Because right now, a rule like this involves an enormous amount of compliance resources on the bank side, an enormous amount of regulatory resources, and it takes the focus off of the true question, which is what are the risks? A lot of it is about just sort of the particulars of measurement, of holding periods, of securities, rather than are there risks being taken. It generates a lot of cynicism on the part of the traders and the bankers, because they say this is not, all these requirements that we have to hit and regulations we have to hit have nothing to do with true risk, but we have to do them anyway. And so it makes people very cynical about the effect of the regulation and the relevance of the regulation. But because they have to do that, there's a lot of resources that are put into it, and also on the supervisory side, a lot of resources are put in. But also it's had this unintended consequence to make markets less liquid. We've seen more occurrences of flash crashes. We worry that there's less capital that are put into these markets to try to withstand particular shocks. And I think that's particularly important today because there have been a lot of other innovations in the markets. There's been development of high-frequency trading, for example, that although existed to some extent a decade ago, really wasn't nearly as much of an important part of the market. So we've had sort of technological innovation that has speeded up trading, in some cases helping to provide liquidity into the markets, but also creating an interconnection and a correlation. What if there's a problem with one of the algorithms? Or what if the algorithms are all doing the same thing at the same time or reacting to a shock in the same way? We don't have the traditional capital that's there in the markets. We don't have the traditional players in the markets as much. And so again, we may have an unintended consequence of making the markets more vulnerable rather than less vulnerable to particular types of shocks. And so again, an important interaction of some of the innovations, some of the technological innovations, but thinking about the basic infrastructure that hasn't really kept up with that. And so I think that's something that is very important to think about. We've had further reforms, both legislative reforms and some other reforms through the Fed and bank regulator process of the Dodd-Frank legislation that had come in about 8 years ago. There had been a lot of concern that somehow the administration was just going to tear it all up and we would just go back to where we were pre-crisis. We're very far from that. So the legislative changes that have occurred have been relatively minor. They've relieved some of the burdens on the small and medium-sized banks, which I think are very sensible. They've tried to do some reforms to Volcker Rule, which I think are sensible. The proposals that so far have come from Randy Quarles have, I think, been important, all in the right direction, but not fundamental. So there's no fundamental change in the capital regime. There's no fundamental change in the liquidity regime. So I think there's been a lot of noise around that, but at least so far, I don't think the regulators have moved in that direction. And I had gotten to know Randy Quarles quite well when I'd worked at the Council of Economic Advisors from 2001 to 2003. He had been at the Treasury Department, and we often agreed on things. And it was only after I left the Fed that I discovered that many of the staff people would refer to the Randys. The Randys think this, and the Randys think that, because they could say, well, the White House and the Treasury were aligned that way. And but that suggests why I would think another Randy Quarles, is doing a good job and going in the right direction, because we have been people who have historically agreed on a lot of different things with respect to regulation and policy. So I think very sensible, sober approach, not a wild approach, not ripping up the regulations, but I think broadly going in the right direction, trying to acknowledge some of these unintended consequences. But now what I want to do is focus on the future challenges. And thinking about, as I said, we've got a lot of innovations, whether it's high-frequency trading, taking over much larger parts of the market, whether it is cryptocurrencies and crypto assets, blockchain, whole variety of new things that are coming in. And I think it's very important to embrace innovation. We don't want to stifle innovation. We don't want to prevent innovation. But we also have to go into it with eyes wide open and understanding that there are risks associated with these different innovations. And it's important to try to get that balance right. And I don't think anyone has the magic solution for that, to be able to get that balance right. If you do try to stop innovation, it's not going to be stopped. It's simply going to go offshore. So I think some people who are very concerned about innovation say we really have to slow these down. I don't think that is going to be successful because it's going to happen somewhere. Or they're going to find ways to innovate that are outside of any particular jurisdictions, which is exactly one of the motivations behind blockchain and some of the cyber currencies and cryptocurrencies and crypto assets, was precisely to be outside of any particular jurisdiction. So I think it is not the right approach to say we're going to try to stop these or crush these, because you're not going to be able to, because it's going to be slip around the different jurisdictions. With the way the internet and cyber work, it's impossible for any particular jurisdiction to stop that, and even trying to get multi-jurisdictions to stop something like that is extraordinarily difficult. So I don't think that's the right approach. I think we have to understand and embrace the positive parts of the innovation, but also, as I said, understand some of the risks that are associated with that. And so one of the things that we really need to think about is especially the payment system, and which is really the heart of the system. This is one of the things where we saw the interconnections really come through so clearly back with the global financial crisis, that payments were crucial. It sort of seems to be a rather boring part of the system, not very interesting. It's just payments. That's not very sexy, but it's the backbone. It's the crucial part. The information systems are also the backbone and the crucial part of these systems. And so, as we use more and more technology, as we use blockchains, as we use crypto assets, and as just things become much more digitized, we also potentially are subject to more risks from cyber. And in the old days, you would have the book that everything was written in, and on how much someone had been borrowing, how much was in someone's account, and of course that book could be stolen, or there could be a fire, or there could be something that would take that out, and so there are risks there. We have gotten comfortable with, well, now with all the IT systems we have, there's much less risk to that because we have all this information, or if there's a distributed ledger, that all this information is around. But it also puts it all onto the internet. And so it's all subject to potential hacking or something that can go wrong. And I think it's extremely important to think about those kinds of risks. Because this is not just crypto, this is not just one particular innovation, but innovations in general, that we're much more subject to some sort of hack or some sort of problem that can go on because of a cyber attack. One of the things that was crucial in the good functioning of the U.S. financial system during the crisis in 2008 and 2009 is that if a bank got into trouble in the U.S., the Federal Deposit Insurance Corporation, the FDIC, if it took over an institution, it made sure that the ATM machines continued to work, that the website never went down. There was never a loss of confidence that you could get your currency out, that you could get your money out. And the FDIC had all the information about how much was in each deposit, and so it could easily allow that to happen. But what if there were a cyber attack that made it difficult to get that information, or if some of that information were lost, or some of that information were corrupted, or a cyber attack that brought websites down, or made ATM machines not work? And that could cause an important loss of confidence and a feeling of chaos. Now, I'm not, so this could come either from a malicious attack, or there could be some other shock that comes to the system that starts to create some questions and concerns, and then there may be malicious attackers who come in and try to get at the heart of the system, get at some of the payments, get at some of these information sources on how much is in people's deposits, get at the websites, get at the ATM machines, and that could cause things to be much more problematic than they otherwise would be. And so I think that's something that's very important to think about from a macroprudential perspective and from a financial stability perspective. Because I think often what we do is we think of technology as being something that is just, well, that's a technical problem. And so, just cybersecurity is a technical problem. These other issues of, digital assets and such, well, those are technical problems. We can just solve those. Those are technical problems, but they're also fundamentally financial stability problems, and ones that we haven't really dealt with or understand that well. And so I think as we go forward, one of the key things that bankers and bank regulators have to think about is working with other types of regulators. In the US, it would be the Department of Homeland Security, and would be with, and also with the military. Throughout the world, I think we would need to think much more carefully about all of these issues. And in order to do that, we need to cooperate with other types of regulators that we haven't worked with, with before. And so I think that's one of the important lessons that I would draw going forward, is that we didn't have the IT systems that we needed when we got into the crisis. We've made some improvements there, but now with such technological innovation, we need to think about new types of risks that can arise. And as I said, I think cyber is not just a technical issue, but should be a core part of financial stability analysis, because there are new types of interconnections that will come up through this, and that we may not be fully prepared for. So hopefully you've seen that we've on my journey from the crisis 10 years ago, that we now have we have the quantitative easing and now the quantitative tightening, which I think has helped to support economic recovery. And we have to be careful in having a smooth exit. But so far, I think the U.S., at least to some extent, Europe has been able to do so. I think we've had some important lessons from the crisis on liquidity, leverage, and interconnections, and we've responded to those, but not without unintended consequences, and by no means perfectly have we eliminated these. And now going forward, we have to think about where are some of the future challenges, and I think there are a lot of benefits for going digital, and with all the fintech innovations, but also some potential financial stability concerns that need to be fundamental to our analysis, not done, well, over in a different department, but fully integrated in with thinking about financial stability and thinking about macroprudential policy. Thank you very much.